Hey, welcome back to Channel 11. I'm your host, Ken Shinoda. Today it's Tuesday, September 2nd, reviewing August. It's getting hot in here is the title because this is some of the hottest times of the year here in Los Angeles. And also the markets are hot. Prices have gone up a lot. Credit spreads have come in. Things are looking a little expensive, a little pricey out there. So let's take a look at what's happening. So land of gains. It's like nothing happened, hitting new highs. We're a little bit off the highs, but it's now a positive year for many credit assets, many equity assets across the globe. It's been a good run. Who would have thought? Sentiment's improving. Here we can see small business sentiments improved a lot off the lows in April. Consumer confidence also improving. And so basically positive sentiment as equities rise and the fears of recession diminish. Atlanta GDP now, strong now, forecasted for the next quarter after that dip we saw because of the pull forward of imports. Based on this model for Atlanta GDP now, no recession being forecasted imminently. Manufacturing still sub 50, manufacturing PMIs, services right there at 50, still expansionary. We saw retail sales pretty strong too. So it seems like recession, is not here yet, although manufacturing has definitely been weak, but it's been now weak for a couple of years here. Prices paid from the ISM reports, highest in a while. This is not good. This is bad for inflation. This is, I think, one of the reasons the Fed was a little worried about it, but I think the jobs data being weak is of more concern than perhaps this transitory spike we're seeing in the prices paid. Employment indices, these are negative. In a way, negative is positive for inflation because the job market is cooling. And so I think one of the signs that maybe don't need to be so worried about wage hikes in the future. And so services inflation remains contained here. Mag 7, huge comeback. Don't you just wish you always bought the dip? Always so scary when you're at the dip. But, off the highs, but big recovery for Mag 7. And so you see a big recovery for market cap versus equal weight. There was a period of winning for equal weight when we all felt that the Mag 7 were expensive, but here we are again off to the races with mega cap tech leading the way. And so that market cap is winning yet again. Our speculative fervor monitor, Bitcoin on the top left, got to a new high off the highs as well, just like the stock market. Dogecoin kind of fading into the history books here, perhaps. Kind of going sideways, so not as much fervor there. But ARK ETF, looking like it's at least new highs over the last couple of years. This chart doesn't go back to its maybe peak right after COVID, and Tesla may be challenged because of things going on with Elon Musk. But I think Bitcoin and ARK a good showing of a lot of that speculative fervor is back. The meme stocks are back too. I saw a couple headlines on CNBC the other day. Bloomberg News seems to not comment as much on the meme stocks, but CNBC loves that stuff. But it's not GameStop anymore. I forget who the new company was. Semiconductors, big sell-off and a rebound along with mega cap tech, but kind of going sideways now. So let's see. There's a seasonal weakness in the equity market that usually hits around September, October. So I think after running super hot, I think you might see a little bit of a pullback in the equity market, maybe some softness in credit spreads or basis points off their tights of the year, as we'll see in a later section. These were the original Trump trades, but they've all kind of changed how they're behaving relative to each other. But you've seen a big catch-up rally in the Russell 2000. It was really lagging, especially during that the April tariff tantrum, let's call it. But it's made a big comeback, especially recently with market expectations of Fed cuts coming in. Lower interest rates are good for small caps that borrow at higher interest rates. The 10-year Treasury kind of going sideways, sitting at 425. With the Fed cutting, the market expecting the Fed cut to 3% or lower now. I kind of think we're right at fair value. Some steepness in the yield curve, about let's call it 125 basis points relative to what the market thinks the neutral rates is. Financials making new highs with the equity market. And the dollar finding some support down here at 99. We like local currency and non-dollar. We've been slowly adding to it. Local currency did really well last year. I think local currency index was up like 3%. But after this big sell-off, it's kind of hard to really lean in on it. So we say, hey, be patient, maybe wait for a dollar rally. And if you see a dollar rally, maybe that's a good time to add to more non-dollar exposure. Equity performance. This is sorted month to date. Russell 2000, best performer on the month. How funny is it that it's up 7.1%, best performer on the month, and it's now up 7.1% on the year. So all the year's gains came this last month. Best year-to-date performer, emerging markets, which many people didn't expect. And over on the far right, you see the FTSE. But S&P, big catch-up. So while Europe has done well, the U.S. has been playing catch-up very recently, but positive returns now across the board year-to-date in the kind of like mid to high single digits, double digits for some markets. International equities, something we've been following over the last couple of months, saying that there's going to be this potential rotation, so international equities could do well along with a weaker dollar, and that's been playing out. I think EM was the one least expected that's been on a tear here. But look at the Nikkei after some weakness again into April, making a huge comeback. FTSE, everything doing really well here. I guess other than the Euro Stoxx 600, Europe has kind of gone sideways. Make Europe Great Again chart. This is comparing S&P 500 versus the MSCI Europe Index. Here you can see that big catch up in the S&P. Europe does better when the line goes down. So very recently, Europe's been going up, but the US has been going up more. So we're giving back some of the mega Make Europe Great Again trade performance. Dollar index, again, kind of flatlining, hard to really lean into a short here after this big decline. I think you could see a little bit of a technical bounce here, and that would be a good time to add to non-dollar if that happens. Euro post-election roadmap, it's almost identical to the last Trump administration. Pretty remarkable how closely this is tracked, which calls for continued strength in the euro. So I kind of like that concept, but again, maybe a little bit of weakness. And look at this, it hit some seasonal weakness back in the last administration too. So maybe it's going to be in that same pathway. Japanese yen had a big rally, selling off a little bit here. This maybe gives you a chance to get long some yen if we back up a little bit more on the yen. And moving to commodities. Commodities, it's a mixed bag story. It kind of looks like it's done nothing over the last, call it 12 to 24 months, but it's a mixed bag performance. So here, this is now sorted again month to date. Livestock, big up month. In fact, we were just looking, before I walked in here in another meeting, we were looking that the cattle livestock has outperformed the S&P 500 this year, just like gold has, up almost 30%. Precious metals also on a tear, gold hitting new highs, 3,500. And then look on the far right, oil laggard, natural gas, big laggard. And so really it's the story of precious metals that's been really driving it. Copper, while up year to date, 15%, really not doing much this last month. So a bifurcated story. The index has a lot of natural gas in there, which is why it doesn't look like it's up much, but some things are doing really well there. Treasury yields. It's again a kind of this bifurcated story. The long end is struggling. It's sitting right there at 5%, can't catch a rally. And then you're seeing a big steepening of the yield curve, the 2-year down to some of the lowest levels we've seen in a long time, right around 3.6%. We looked at it earlier. The 10-year kind of going sideways, 4.25. The 5-year at the shorter end of the curve doing better, like the 2-year. And really this big steepening on the left. You see 2s10s hitting a new recent high, 2s30s hitting a new recent high. Big move. Look at that from -1 to now kind of like 130 and 133, I think, on the 2s30s. Fixed income now on the month, good month except for levered loans, CCC loans, positive returns across the board. You see the index up 1.2%. On the far left, Treasuries up 1, agency mortgage spreads coming in with vol dropping, doing well there, up 1.5%. Floaters lagging, AAA CLOs only up 50 basis points. Really, it's fixed rate bonds doing better and risky credit also doing okay. High yield corporates up 1.2%. So now year to date, some of the high quality stuff had lagged, but duration is kicking in. So agency mortgages now up 5.5%, actually beating investment grade corporate bonds by 20 basis points, up 5.3%. But high yield over the last couple of years continues to win. Defaults have been low, yields have been high. while there's been some vol in spreads and vol in rates, it's been clipping some really good returns over the last couple of years. But spreads have been coming in on many of these markets. EM also has had a great run last couple of years, having longer duration winning, and also coming from wider spreads out of the 22, 23 spread widening environment. So credit year-to-date performance, we looked at this after April, and half these credit sectors were negative return in the red, some meaningfully negative, and now everyone is winning. Literally everyone is winning. EM is winning the most, up 8.4%. Risky stuff like BB CLOs, BBB CMBS, BB high yield, up the most. And as you go up in quality and floating rate, you are doing worse. AAA CLOs, for example, not having that duration, just basically earning their carry, up 3.7%. But that's okay. They're pretty low vol asset, and they're floating rate, so you shouldn't expect much more from them other than their carry. Market implied Fed funds. So the red line is the beginning of the year. The market expected we'd end around 3.9 at the end of the year, but expected much more cuts sooner on. So the market expected us to cut sooner, and we've been higher for longer, basically. But now we're playing catch up. So I think the market really thinks we're going to get a cut this coming September, especially after some of the comments at Jackson Hole, and then maybe we're on kind of wait and watch to see when the next one's going to be. But it seems like it's going to be a pretty non-controversial 25 basis point cut. We'll know soon enough in a couple weeks. Break-even inflation rates, the longer break-evens, 5-10 years, remain contained. The 2-year ticking up a little bit, but two-year nominal yields falling, so real yields actually falling on shorter-term real yields. Now looking at credit spreads, we got to extremely tight levels at the beginning of the year. We sold off into the tariff tantrum, let's call it. And it's with equities rallying and risk markets doing well, we've tightened a lot. We basically got back to those historically tight levels on investment grade corporate bonds. And we're widening a little bit coming out of Labor Day with this little sell-off in equities, but it's not much. I mean, we got to like 75 basis points or 79 basis points. High yield, similar story in the sense that we were at very tight levels, around 250-ish on high yield OAS, widened all the way to 450. And then now we've been grinding back tighter in high yield spreads. So looking pretty tight in high yield as well. On a spread change basis, the gray is changed from year end. So there's still some sectors that are wider from the beginning of the year. Barely. You're talking 5 to 16 basis points for BBB CLOs. And everything is tighter, especially EM sovereigns. And here you can see CMBS BBBs. They kind of lag the rest of the market as the commercial real estate market continues to heal. Those CMBS BBBs are starting to play catch up. And here you can see the tightest spreads in IG corporates. And then as you go out into some of these securitized sectors, you get to pick up more spread versus corporates for investment grade bonds. And as you go out the risk spectrum into high yield and bank loans, you get to pick up even more spread. CMBS BBBs stick out because there's definitely some default risk there, so they should be wider. They're probably not BBB anymore. They're probably more like CCCs. So what looks cheap now? Well, at the bottom of the screen, investment grade, corporates, high yield look pretty expensive. People are still buying them. They're looking at the yield and saying, I know spreads are tight, but these yields are still relatively attractive, perhaps for my actuarial needs or my income needs if you're a retail investor or an advisor. And then as you go into the securitized sectors, you get a little bit more value, but the value has been diminishing. So if we go back a couple months, RMBS AAAs were up more like 60th percentile, 70th percentile. Agencies were maybe closer to 90th percentile. Legacy was up at like 70, 75th percentile. CMBS was up at 60th percentile. Everything's coming down because you're seeing spread compression. But if you really need to put capital to work, those securitized sectors still provide more value. Maybe not CLOs because they've come in more, but you're still kind of average valuations for mortgages and above average valuations for agencies. So some of the interesting things that are out there, I wish there was some more vol so we could talk about something exciting to buy, but spreads have come in, stocks are near their highs, and it's been a hot market. So hopefully we get a little bit of a shakeup. That's what we like when we're investing, and we'll look to maybe a pullback or some kind of vol going into this seasonally weaker time of the year. Take care and enjoy the new school year.